Welcome to Counttuts. In this lesson, we're going to be explaining what cost of sales is and how to calculate the cost of sales. So hopefully after this lesson, you should be able to have a very good grasp of what this is all about. So firstly, how do we define cost of sales? Well, cost of sales, also called cost of goods sold, is the direct cost of the inventory that was sold during the period. And inventory is what an entity sells in its ordinary course of business. So if you're looking at BMW, for instance, it sells BMWs, meaning vehicles. And so the vehicles would qualify as their inventory. And so this is the direct cost of the inventory that was sold during the period. And so an example is if you have a company that buys vehicles so that it can sell them. If it made sales of 10 million rand, for instance, the question would be, how much did the company buy the products that it sold for? And that is exactly what cost of sales is. So it's the direct cost of the inventory that was sold during the period. And so as I've just mentioned, cost of sales and cost of goods sold are sometimes used interchangeably, but cost of sales is generally what it costed the company to make the sale. Cost of goods sold specifically looks at the cost of the product that is being sold. Okay, so that's the strict nuance between cost of sales and cost of goods sold. Why do we calculate cost of sales? Why is it important? Well, it's extremely important. It goes into our income statement, as we shall see shortly, or the statement of profit or loss and other comprehensive income, but it helps calculate gross profit. If you know your income statement or the statement of profit or loss and other comprehensive income, you know that we begin with sales and then we deduct cost of sales, and then what we get is what is called gross profit. And so cost of sales is important because it helps us calculate our gross profit. And so with that being said, of course, cost of sales is an expense and it's shown in the income statement as I've just mentioned. And so cost of sales being an expense goes on the debit side. If you know your debits and your credits, okay, every expense goes on the debit side, with cost of sales being one. Now, I've already explained that cost of sales goes into the income statement or the statement of profit or loss and other comprehensive income. Those terms can be used interchangeably. So if you hear me saying income statement or the statement of profit or loss and other comprehensive income or the statement of comprehensive income, I'm referring to the same statement. And here's how this statement looks like. I've just taken it from the internet. This is for Pick n Pay, I believe. I've looked at various companies' income statements, and so I think this one here is for Pick n Pay, which is a grocery retail chain. And so what you'll see here, as I mentioned, you've got revenue, which is made up of the sale of merchandise, and then just under that you've got cost of sales. And so you can see a cost of sales is an expense. That's how you can see it in bracket, meaning it's being deducted from the sales to get what is called the gross profit. So if I remove the circle there, you can see it's sales minus cost of sales gives you the gross profit down here. This is where cost of sales goes. It's the second line item in the income statement. And so having defined what it is and explained why it's important and where it goes in our annual financial statements, how do we calculate cost of sales? In other words, how did Pick n Pay come up with this amount of 182,968,000 rand? Well, let's have a look at the formula for calculating cost of sales. In simplicity, here's what it looks like, and I'm sure you may have looked at this or you may know this already. Opening inventory plus purchases minus closing inventory, and that will give you cost of sales. And so why this line item specifically? Well, I've already explained what inventory is, what the entity sells in its ordinary course of business. And so for Pick n Pay, for instance, that would be the groceries that it sells. And the question would be, how much did it cost Pick n Pay for all the groceries that it sold? And that answer would give you what is called cost of sales. Now, how do we calculate cost of sales? We take opening inventory, meaning the inventory that an entity has at the beginning of the period, and then we add our purchases, meaning the inventory that we purchased during the period, and then we deduct closing inventory. Why do we deduct closing inventory? Well, because closing inventory is the inventory that is remaining within our premises. It's the ones that we didn't sell. And so we want to isolate the ones that we didn't sell to remove it so that we can see how much did we actually sell. And so if you think of this logically, my opening inventory plus my purchases is ideally what I would sell this year. But if I have closing inventory, those are the ones that are remaining, so I need to deduct it to get our cost of sales. So this is the simplified formula for calculating your cost of sales. However, sometimes you have other line items that go into the calculation of cost of sales. For instance, you're purchasing from your supplier the inventory that you're going to sell, but sometimes you will return some of these goods to your supplier because maybe they're defective or they supplied you with the wrong type of goods. And so what do we call that? We call that purchase returns. And so how does it factor into our formula? Well, opening inventory plus purchases, and we deduct purchase returns. Purchase returns are the inventory that we bought, but we return them to the supplier for one reason or another. And so that's why we're deducting purchase returns, okay? Because it's included in our purchases. And remember, we record all our purchases, but when we return the goods to the supplier, we refer to that as purchase returns. And what you see in brackets here is, of course, the deduction of the purchase returns. And that may not be the only one that you have. You also have what is called carriage on purchases or freight on purchases, okay? So here's the idea behind this. Remember, whatever it costs you to bring the inventory to your warehouse or to enable you to sell this inventory, that will be capitalized, or meaning it will be added as part of the cost of the inventory. And so we want to add that, okay? So if you have any carriage on purchases or freight on purchases, you want to add that because that would form part of your cost of inventory or cost of trading stock. And by the way, other words for inventory would be trading stock or goods or merchandise. And so don't be alarmed when you're seeing we're using the word inventory and you've seen elsewhere the word merchandise or stock or trading inventory. All those words may be used interchangeably, okay? So now you know what to do if you have a different term for the exact same thing. And by carriage on purchases, we actually mean how much it costed you to bring or to transport the goods to your warehouse or to wherever you store them in order to sell them. Sometimes they may use the word carriage inwards. Okay, so carriage inwards or carriage on purchases, whatever it costed you to bring the inventory to a place where you can sell them, that is what you will include as a positive as part of the calculation for cost of sales, because it forms part of the cost of your inventory. Remember, what you're concerned here is the cost of our inventory, and that's what cost of sales is. One, the cost of the inventory that we actually sold. That's why at the end of the day, we're deducting closing inventory. But you want to be careful here. Sometimes you'll see the word carriage inwards and carriage outwards. Remember, carriage outwards is how much it costs you to deliver the inventory to your customers. That has nothing to do with cost of sales. That has nothing to do with the cost of our inventory. So it does not form part of the calculation of cost of sales. In fact, that term, carriage outwards or carriage on sales, is an operating expense. So it has nothing to do with the cost of sales nor sales. So that's just something to clarify, because that's where the confusion may be at times. But I'm sure you now understand what carriage on purchases is. What's the other line item that we may have? We may have what is called import duties or custom duties, meaning the taxes that you pay when you're importing the inventory. That will form part of the cost of your inventory, and that is why we are putting it as a positive. You may also have what is called drawings. And what is drawings? Well, drawings is whatever the owners of the business have taken for their own personal use. Remember, they can take anything. They can take money, they can take vehicles, they can take machinery, they can take a building for their own personal use. Drawings may be any of those things. However, if they take inventory, or trading inventory or merchandise, as I've mentioned, those are interchangeable words, then you have to deduct it, put it as a negative. And that's why we're specific here to say drawings of inventory only. If they tell you that there was drawings or the owner took vehicles for their own personal use, that has nothing to do with inventory, unless we're in the business of selling vehicles, of course. And you'd like to understand more on what inventory really is, we've got a lesson specifically on that. You'll find it in the link in the description below. But all that to say, whenever the owner takes specifically inventory for his personal use, then we will deduct that amount from our inventory, meaning we're deducting it from our cost of sales. As you can see here, it's negative. And this is how we go about calculating cost of sales. So I'm sure you'll bump into any of these words here and you'll know exactly what you need to do. But think of it logically, not just trying to cram the formula. Remember, logically here is to say that all the inventory that we sold, want to see how much it costed us to buy that inventory in its entirety, and that will form part of our cost of sales. And when you look at the formula, it should make sense. We've got opening inventory, how much inventory we had at the beginning, meaning how much it costed us, and we would have calculated this last year, and that's why it's opening inventory, the ones that remained from last year, plus purchases, meaning how much inventory we bought this year. We deduct our purchase returns, because we've returned them to the supplier, it's no longer with us, and we add our carriage on purchases because it forms part of the cost of our inventory. We add import duties or custom duties, forms part of our cost of the inventory, and we deduct our drawings, meaning the inventory that the owner took for his or her personal use. Because we didn't sell it, we have to deduct it, and we also deduct our closing inventory, because we know for a fact that closing inventory is not what we sold, it's still what's lying in our premises, and that is how we get cost of sales. Now, it's important to mention this from the International Accounting Standards, which is a standard that we apply, and this is what it says on the cost of inventories: cost of purchase, including purchase price, import duties and other taxes other than those subsequently recoverable, and transport, handling, and other costs directly attributable to the acquisition of finished goods, materials, and services. And this is the rationale behind why we are adding these line items: import duties, custom duties, carriage, and purchases, whatever the case is. But you can note here it says other than those subsequently recoverable. What would that be? That would be something like VAT, and that is why we remove VAT from the cost of the inventory. It should not form part of the cost of the inventory if you are a VAT vendor, because if you are a VAT vendor, you're going to claim that back from the revenue authority, and so whatever we're going to claim back should not form part of our inventory. And that's why it's saying here other than those subsequently recoverable, because we're able to recover the VAT portion back. But if you're not a VAT vendor, you're not going to recover it, and it should form part of your inventory. Now, here's something important to mention. Based on what we've done here on the calculation, it's important to understand the inventory system that you are using. And so let's have a look how inventory systems affect cost of sales. How does it affect our cost of sales? Well, there are two specific inventory systems that we deal with here. The inventory system used, either periodic or perpetual, has a direct impact on how cost of sales is calculated and recorded. Very important. Based on the inventory system that we're using, that will impact how our cost of sales is calculated. It doesn't mean you'll have a different amount for cost of sales depending on the inventory system, but it has an impact on how the calculation is done. Now let's look at the periodic inventory system very briefly, because we've done lessons specifically on the periodic versus the perpetual inventory system. You'll find it in the link in the description below as well. But with the periodic inventory system, inventory records are updated at the end of the period, and you'll see what is called purchases in your trial balance, for instance, and you'll see this shortly. And another thing is that cost of sales is calculated manually using the formula we went through. Remember the formula in the previous slide? That formula is used in the case where the entity is using periodic inventory system, because inventory records are only updated at the end of the period and not continuously. And as such, cost of sales is not known until the end of the period. So we'll not know what the cost of sales is until the end of the financial period. So if you're told that the entity is using the periodic inventory system, that means you'll have to use the formula that we just used to calculate your cost of sales. This system requires a physical count of closing inventory, okay, so where someone will go and manually count the inventory to account for it. Although with the perpetual inventory system you may also have the physical stock count, but that's merely just to see that what we have in our books as our inventory is the same as what we have in our storehouse when we physically count them. But with the periodic inventory system, we have to go and count it in order for us to get the value for our closing inventory. What about the perpetual inventory system? How does that work? Well, inventory and cost of sales are updated continuously, and as you may note, the word perpetual also means continuous, and so we're updating our cost of sales continuously, so we don't have to apply the formula we looked at in the previous slide. Each sale immediately reduces inventory and records cost of sales. And you will note that with the perpetual inventory system, there are two journal entries that you capture. One is for the sale of the inventory, and the second is for the cost of sales, and we'll look at this just now. Cost of sales is known in real time, and so if you look at the trial balance of an entity that uses the perpetual inventory system, you'll see the word cost of sales there, so you don't have to do any calculation for cost of sales. However, with the periodic inventory system, as we've just mentioned, you have to do the calculation using the formula that we mentioned in the previous slide. With the perpetual inventory system, inventory account is always up to date. You will know what your inventory is at any given point in time. And by the way, this system is used by most modern entities like Pick n Pay, for instance. When you buy groceries and they scan the barcode, that immediately removes that product from the system, and it tracks how much inventory has been sold and how much remains with the entity. So this is how the inventory systems affect your cost of sales, and I hope that's made sense. To get more understanding on this, refer to the lesson that I alluded to. The link is in the description below. Now, here's an example for us to calculate our cost of sales, and you'll see how cost of sales is calculated specifically using the perpetual inventory system. Look at this example. Sold trading inventory for 15,000 Rand that cost 4,000 Rand. Prepare the journal entries. Now, if you paid attention to what we said at the beginning, cost of sales is how much it costed us for the sales that we made. So that means if you sold inventory for 15,000 Rand, how much did it cost us? It costed us 4,000 Rand. So it's easy. 4,000 Rand is our cost of sales. And so what is our journal entry? Whenever we make a sale, we either going to debit bank or debtors, depending on how we sold it. If we sold it on cash, we debit bank. If we sold it on credit, we debit debtors or trade receivables, and we credit sales. And here's how it's going to look. Okay, debit bank or debtors 15,000 Rand, and credit sales 15,000 Rand, and that is for the sale of inventory. So if the person bought it on cash, as I've mentioned, you debit bank. If they bought it on credit, you debit debtors or trade receivables. And this is how you will always capture it, regardless of whether you're using the periodic inventory system or the perpetual inventory system. And this is where you'd stop if you're using the periodic inventory system, because you're only going to account for the inventory at the end of the period. However, if you're using the perpetual inventory system, accounting for your inventory and cost of sales perpetually, meaning continuously, here's the second journal entry that you'll have to do, where you debit cost of sales. Remember, cost of sales is our expense, and our expenses are always debited. If you'd like to know what accounts are debited and what accounts are credited, refer to our Accounting for Beginners series, and you'll find the links for those in the description below as well. So we debit cost of sales, and what we're going to credit? We're going to credit inventory. Why is that? Because inventory is an asset. Our assets are usually debited, but when our assets are decreasing, we do put it on the credit side. And so when we're putting inventory on the credit side, we're saying that it left our premises. And why is that? Because we sold the inventory. So we're going to debit cost of sales 4,000 Rand, credit inventory 4,000 Rand. And so for every sale that we make, this is the journal entry that we will have to pass if we are using the perpetual inventory system. However, if you're using the periodic inventory system, the second journal entry will not be done, okay? Because you'll use the formula that we looked at earlier to calculate your cost of sales at the end of the period. I hope it makes sense. I hope you can see how cost of sales is accounted for here. Remember, we're looking at this lesson specifically for cost of sales, and I just wanted to show you how cost of sales is accounted for, specifically if you're using the perpetual inventory system in this particular slide. You just ask yourself, how much did it cost me to buy the inventory that I just sold? And that will be the amount under the second journal entry. Now, here's an example of how the trial balance will look like depending on the inventory system that is being used by the entity. Look at the first trial balance on our left. What I'd like you to do here is to pause the video, and in a few seconds you should be able to answer this correctly if you understood everything we've explained so far. Which of the trial balances uses the periodic inventory system and which one has used the perpetual inventory system? Meaning, these are two different entities. Which entity uses the perpetual inventory system and which one uses the periodic inventory system? Try and pause, look around, and then guess what the answer is and press play. Okay, I hope you've looked at it. The answer is quite simple. Let's look at the first one on the left. We've got here the statement of financial position section, or the balance sheet section, and the nominal account section. That's how our trial balance always is. But you can see here under nominal account section, we've got sales, and under that we've got cost of sales. And so this is the pre-adjustment trial balance, before adjustments. And so if that's the case and we're given cost of sales, it means the entity uses the perpetual inventory system, meaning they've been accounting for their cost of sales perpetually or continuously. But look at the one on the right. We look at this one here. Of course, they didn't divide it between the balance sheet account section and the nominal account section. However, we can still find either cost of sales or purchases. And if you look around, you will see down here, we've got purchases, okay? The fact that they've given us purchases tells us that they have not been accounting for their inventory and cost of sales continuously. That means they're using the periodic inventory system. With that being said, we have to calculate our cost of sales manually. Okay, that's what you'll have to do in this case. And so I hope you can make sense of the trial balance by just looking at what amounts they've captured, and you will know what inventory system they have used. If they've given you cost of sales, they're using the perpetual inventory system. You don't have to calculate the cost of sales. If they've given you purchases, you know that they're using the periodic inventory system, and you have to calculate cost of sales using the formula that we looked at earlier. And so we're going to look at another example now where we're going to calculate our cost of sales. But just for interest's sake, how would you calculate your cost of sales? Well, remember the formula, it's opening inventory. And so where's our opening inventory? Well, we know our financial year ends on the 30th of June 2015, and our financial year began 12 months ago, which would have been the 1st of July 2014. And you can see here inventory, and in brackets 1st of July 2014, that's our opening inventory. So you take your opening inventory, right, plus your purchases. You're given purchases down here, and then what else are you going to add? Well, you just have to look around. You can see here under sales, we've got carriage on purchases, so we're definitely going to add this. Import duties on purchases, you're definitely going to add this. Insurance on purchases. Now this is where you'll have to ask yourself, is this insurance that we needed while our purchases were still in transit, or is this insurance for keeping our inventory in our warehouse? Well, I believe this is insurance while the goods were coming to us. If that's the case, we'll have to add the insurance on purchases. However, if they tell you that the insurance was for you keeping the goods in your warehouse, that has nothing to do with the cost of sales. That will be insurance expense under operating expenses section. I hope that has made sense. Okay, so you've got insurance on purchases as well. You put it as a positive on your calculation for cost of sales. And do we have anything else here? We've got purchase returns. You can see down here purchase returns. Remember, you have to deduct this because you return some items to the supplier. And then what else do we have? That's all we have. And you'll see down here something that I mentioned, carriage on sales. That has nothing to do with our cost of sales. It also has nothing to do with our sales. Okay, this is an operating expense, so don't make a mistake and add carriage on sales. We only add our carriage on purchases. Okay, and then we deduct our closing inventory, and that would be given in additional information which is outside of what we have here. Okay, but we just looked at the trial balance to see where we'd get our information, and so you'd have to look for your closing inventory, and usually they'll give you additional information for the closing inventory, and you'll have to deduct what that closing inventory is. And so you can see here, by just looking at it, you know how to calculate your cost of sales. First one on the left, it was calculated for us because they're using the perpetual inventory system. You don't have to do any calculation. On the right, they've given us purchases. The moment you see purchases, you know you have to bring up that formula and calculate your cost of sales, as we have explained earlier. Now, look at this example here. What I want you to do is to pause the video and attempt this question. Look at the required. It says calculate the cost of sales amount. Show all your calculations. And so this is the best question to gauge your understanding of everything we have looked at thus far. At this point, you should be able to do the calculation because we've looked at everything that you need for you to do this calculation. So pause it, attempt the question, and then press play, and then see how well you would have done. Okay, I hope you have done that. I hope you've paused. I hope you've attempted it. And so let's calculate our cost of sales. Of course, the first thing that we're going to bring up is our opening inventory. Where is our opening inventory? Well, let's look at our financial year end. All right, we are told here this is the extract from the pre-adjustment trial balance on the 31st of March 2022. That means it started on the 1st of April 2021. And so I'm looking for inventory at that date. And you can see down here, I've got trading inventory, 1st of April 2021, 12 months ago. That's our opening balance, 36,000 Rand. And so I'm going to bring my opening inventory, 36,000 Rand, as a positive, of course. And so let's go down on our table. We've got purchases. Remember our formula, opening inventory plus purchases of 960,000 Rand. So we're going to add that, plus purchases of 960,000 Rand. And then next, we've got custom duties. So we're just going to work our way down. We've got custom duties of 1,100 Rand. Remember, we have to add our custom duties because it forms part of the cost of our inventory. So custom duties plus 1,100 Rand. And then we've got import tariffs. This also is added. Whatever import fees we're going to pay or import taxes we're going to pay, we're going to add it to the cost of our inventory. Remember, I read from the standard what is required to be added as the cost of your inventory. So import tariffs, 3,560 Rand. We're definitely going to add that. And then we've got purchase returns, 12,200 Rand. Well, that's definitely going to be deducted, right? Because we returned some inventory to our supplier. So we're going to deduct it, put it as a negative. So minus purchase returns, 12,800 Rand. And then we've got sales down here. That has nothing to do with our cost of sales calculation. And then we've got freight on purchases. This is also added to the cost of our inventory. So we're going to put it as a positive plus freight on purchases, 216,000 Rand. Now looked at everything on our table. Let's look at adjustments and additional information. Hope you got everything correctly thus far. The first one says the owner took goods with a cost price of 11,000 Rand for personal use. No entry has been made to record this. The fact that they told us no entry has been made to record this, we have to record it. Remember, what do we call it when the owner takes goods for his personal use or he takes something for his personal use? We call it drawings. And you can see specifically here the owner took goods. Okay, if they took something else, equipment or furniture or even a building or even cash, that would have nothing to do with our cost of sales, as we've already explained. But the fact that they took goods, we're going to record this as negative 11,000 because that has nothing to do with the sale of our inventory. So it won't form part of our cost of sales. Cost of sales has to relate specifically to what we sold. But since we didn't sell these goods, the owner took them for his personal use, then we're going to put it as a negative to remove it from the calculation of our cost of sales. Another thing that is important here is that they gave us the cost price. If they gave us the selling price or the amount that it would have been otherwise sold to someone else, then we'd have to figure out what the cost price is. Because remember, cost of sales looks at the cost price. How much did it cost me? Not how much am I going to sell it for. No, it's only how much it costed me. So that is why we're deducting only the cost price. And then number 2 says an invoice received for import duties 17,000 rand has not been recorded. So we have to add that 17,000 rand as import duties. Remember, back to our formula, we're going to add import duties. Whatever import fees we've paid, as I've mentioned with the import tariffs as well, we're going to add it to the cost of our inventory. So plus import duties, 17,000 rand. And then lastly, we are told a physical stock take after the above transactions on the 31st of March 2022 showed that stock on hand was 35,000 rand. What do we call that? Closing inventory. And what do we do with our closing inventory? We deduct it if you know your formula well by now. So we're going to deduct 35,000 rand as our closing inventory. And we've taken into account all the information that they gave us. All we need to do is to sum it up and see what our cost of sales is. We're going to take opening inventory plus purchases plus custom duties plus import tariffs minus purchase returns plus freight on purchases minus drawings plus import duties minus closing inventory, and that will give us a cost of sales of 1,174,860 rand. This is how you go about calculating your cost of sales. I hope you got it correctly, and if you attempted it and got it correctly, well done. If you didn't, you might want to go back and re-listen to some of the things that you mentioned or the highlights that you mentioned, or even the things that we looked at before attempting it again and see where you went wrong. Otherwise, I hope you've gained value from this lesson. I hope you know what the cost of sales is and how to calculate it. If you have indeed gained value from this lesson, consider subscribing to our channel, like this video, and share it to those who think it might help. Till next time, cheers.